Today, we're taking a closer look at what some are calling a calculated disruption in the markets, a perspective that may trace its roots to decades-old lessons learned during one of finance's most dramatic moments. Treasury Secretary Bessent, whose background includes working for Soros during the British pound crisis, is now at the centre of an incredibly high-risk economic strategy aimed at strengthening the dollar. But his approach, some say, involves doing precisely the opposite of the warning signals he encountered during that historic market upheaval. Over recent week, tariff announcements have sparked significant volatility on Wall Street. The strategy being implemented today can be interpreted as appearing to serve a dual purpose. Domestically, the tariffs are designed to force a re-examination of key economic indicators such as overinflated housing markets and unstable Treasury yields, and to prompt a deleveraging process on Wall Street. By imposing what some call a controlled market shock, his idea could well be to expose structural vulnerabilities before they can be exploited, creating a stronger foundation for longer-term economic stability. At the same time, on the international front, these measures are intended to restrict the influence of major export-driven competitors, most notably China. By putting additional pressure on China's export model, the policy could contribute to a weakening of the Chinese currency. In theory, this would lead global investors to seek the safety of US Treasury bonds. The resulting downward pressure on interest rates could then ease refinancing of several $1 trillion in expiring debt, a challenge facing the United States today. Now, this approach has been described as a white hat hacking the dollar, a preemptive and strategic stress test aimed at reinforcing the currency's resilience. However, while some argue that this method is a pragmatic move to fix long-standing economic imbalances, others question whether a deliberately induced market shock can effectively prevent broader financial fallout. The risks are clear. Abrupt adjustments in the market can trigger unintended consequences that ripple across the financial system and even risk damaging the US's status permanently among its allies. Historical context is also central to this discussion. Bessent's experience during the British pound crisis, when market fundamentals unravelled and leverage reached dangerous levels, provides him with a unique insight. His first-hand knowledge of the warning signs from that era could be underscoring the current strategy, which appears to balance short-term disruption with the longer-term goal of economic stability. Ultimately, we're left with several critical questions. Are these tariff measures truly a calculated tool to realign US economic fundamentals, or might they unintentionally exacerbate market volatility? Can the lessons of the past, embodied in Bessent's strategy, serve as a reliable guide in a rapidly changing global economy? And ultimately, will this approach fortify the dollar against future exploitation whilst mitigating risks both at home and abroad?